Okay, good morning, everyone. The conference will begin in a minute. Okay, now I'm opening today's conference, the 2021 KARMI webinar. KARMI stands for K or Korean ASEAN Risk Management Insurance. This year's subject is the ESG, finance, and ASEAN. Yesterday, we covered ESG and finance topic presentation. Today, we will focus on the finance and the ASEAN. So we have 10 presentation of the ASEAN young scholars following the morning session with the professors and doctors from the United States, which is in the evening now. Because of time difference, I organized the schedule with the morning for the United States scholars. And in the afternoon, we will have many presentations, about 15 presentations, including 10 ASEAN scholars. So today will be the day for finance and ASEAN. This is the schedule for today. Okay. Professor Won-Dong Lee for special talk or presentation. The Sharon Tennyson from Cornell University, Yu Kyung-ho from NYU, and me, and Linda from Laos, Han-Hong Lee from Vietnam, Ulita Pirom, Ulita from Laos, and the Pirom from Cambodia, Taesumong from Myanmar, Yangon University of Economics, and Chatsuang, Kim Chorat, also from YUE, for same, and So Young Lim from SKKU, Mamun from Bangladesh, Dinti Tan Bang from Vietnam, Yao Han Lee from Hong Kong, and Jung Hee Yu and Chon Ube from Korea, and Eddie Generation from Indonesia. So we are running for 9 hours, from 9 to 6 p.m. Okay, so long, it will be a long day. Okay, now I'm inviting the first and foremost speaker of today's presenters, Professor Won-Dong Lee from Daegu University. He graduated from University of Alabama for his PhD degree, and he has served for 30 years, more than 30 years, for the Korean Insurance Academic Society. And he served also for the Daegu University as dean and the acting president 6 months ago. He is delivering a speech about the oral hazard from different perspectives. So please welcome Professor Won-Dong Lee.
Can you hear me?
Yes.
All right. Good morning. Very chilly morning in Korea.
Good morning.
My name is Won-Dong Lee. I'm teaching risk and insurance at Daegu University. It is an honor to be a part of this conference. Almost 3 years ago, early 2019, I attended the same conference, which was held in Ho Chi Minh City, Vietnam. I have many good memories. I remember staying in an old French-style hotel on the beautiful Saigon riverside area, visiting the War Museum and Art Gallery, and strolling along the lively streets. And I experienced good hospitality from Ton Duc Dang University. However, I can't remember what I presented and what was presented at the conference. So I missed the on-site conference before COVID-19. Now, let me share my PowerPoint screen with you. 스크린이 공유가 안 된다는데요.
Okay, you can do it now.
Okay, can you see it?
Yes, we can see it.
Okay, today I would like to talk about information asymmetry in the insurance markets from somewhat different perspectives. I think it is more than somewhat, rather it is radical ideas to the conventional theory. There has been a growing body of research that information asymmetry in insurance market may not diminish welfare. In this presentation, I will introduce two representative studies by John Nyman and Guy Thomas. As you may know, this photo and biography have been inserted at the request of Professor Hong Ju-jung, the organizer of this conference. This photo was taken at the Samsung Lions baseball stadium in Daegu last spring, when the Samsung Lions and the NC Dinos played. Due to the pandemic, admission to the ballpark was partially restricted. So there were a few spectators in the outfield stands. I missed the noise and crowded baseball fields before COVID-19. Okay. Before getting into the challenging ideas, let's briefly review the conventional theory of information asymmetry in the insurance markets. In the economics literature, information asymmetry deals with the study of decisions in transactions where one party has more or better information than the other. In other words, information asymmetry occurs when the buyer and seller of a good or service have different levels of information about the good or the service. This information asymmetry creates an imbalance of power in transactions, which can sometimes cause the transactions to be inefficient, causing market failure in the worst case. A classic example of this is George Ecclef's 1970 paper, Market for Lemons, where a used car salesman knows something about the real quality or lack of quality of a product and does not reveal it to the buyer. In such a situation, buyers are only willing to pay an average price for a used car. However, sellers will sell only when they have lemons, bad quality cars, and if they have good quality cars, they will leave the market. As sellers with good quality cars leave the market, the average willing to pay of buyers will decrease. Eventually, this market mechanism can lead to a market failure. In 2001, George Ecclef, along with Michael Spence and Joseph Stiglitz, jointly received the Nobel Prize in Economic Science for their research on asymmetric information. As you may know, Ecclef's spouse is Janet Yellen, the current US Secretary of the Treasury, and the former chair of the Federal Reserve, what a powerful couple they are. In the insurance economics, individual insured, the buyers of insurance, are usually assumed to know more about their risk type and their future preventive behavior than the insurance companies. Therefore, the insurance company suffers from a lack of information. Of course, this basic assumption is open to criticism. Sometimes individual insured suffer from a lack of information. However, here in this presentation, for the consistency of discussion, I will not consider the reverse cases where the insurance company has informational advantages over individual insurers. Anyway, this asymmetric information has two phenomena that have been known to the insurance markets for a long time, namely moral hazard and adverse selection. In the context of insurance, two concepts can be defined as follows. Moral hazard is defined as a tendency of the individuals with insurance to reduce their loss prevention efforts. Moral hazard is the lack of information about the hidden action of the insured that increases the expected losses after the conclusion of an insurance contract. Meanwhile, adverse selection is defined as the tendency of the individual with high expected losses to purchase more coverage than the individual with low expected losses when charged the same premium. Adverse selection is the lack of information about the hidden type of the insured, resulting in a higher expected loss for the group of insured before entering into an insurance contract. From these definitions, you may notice the difference between moral hazard and adverse selection. Moral hazard is asymmetric information about the insured action. This action is not observed by the insurer, so we call it hidden action. This hidden action increases the expected losses of the individual insured, and accordingly, the expected loss of the insured group after insurance coverage is purchased. So moral hazard is merely about the incentives created by the insurance contract. On the other hand, adverse selection is asymmetric information about the risk type or characteristics of a person who is attracted to a particular insurance contract. This happens before or at the time of insurance contract. Since the insurance company does not know the true risk of individuals, we call it hidden type. Then insurance company has to offer average price or pooled premium, which is expensive to the lower riskers. So lower riskers tend to give up the contract or move to other insurance company offering them better deal. The insurance contract with an average price attract only higher riskers. Eventually, the insurance company becomes insolvent with its rising loss payment caused by higher expected losses of the insured group. And what moral hazard and adverse selection have in common is that they raise the expected loss of the insured group. Consequently, they change the basis for calculating the premium and drive up the cost of providing insurance protection, causing the decrease of supply of insurance protection, inefficient insurance markets, and welfare losses to a society as a whole. Therefore, these information asymmetries tend to have a significant negative connotations in the insurance markets. As you know, most provisions, terms and conditions of insurance policies are designed to reduce or minimize moral hazard and adverse selections. Before we get to the point, it's worth mentioning one more thing about the types of moral hazard. Moral hazard can be divided into two types. ex ante moral hazard and ex post moral hazard according to the time of behavior changing. Ex ante moral hazard refers to a change in behavior prior to the loss event, and ex post moral hazard prevails when an individual has an unobservable effect on the magnitude of the loss after the loss event. Health insurance provides a good example of an ex post moral hazard because the size of the loss is not predetermined. Individual insured persons have an incentive to get extra medical care because health insurance covers most of the extra cost. Additional spending with health insurance is a good example of an ex post moral hazard. From now on, I will use the ex post moral hazard of health insurance to counter the conventional theory. Let's move. There has been a growing body of research that information asymmetry in the insurance market may not diminish welfare. In this presentation, I will introduce two representative studies by John Nyman and Guy Thomas. John Nyman is a professor emeritus in the Division of Health Policy and Management at the University of Minnesota, United States. He developed a model presenting an alternative view of moral hazard in the context of private health insurance. And Guy Thomas is an honorary lecturer in actuarial science at the University of Kent, United Kingdom. He argues that some degree of adverse selection in the insurance markets is not only desirable, but necessary for greater market efficiency. His argument is working well for personal insurance, such as life and health insurance. They have published many related articles in academic journals and also books by University Press. Stanford and Cambridge published Nyman's book and Thomas' book, respectively. Let's move on to Nyman's theory first. Conventional theory of health insurance holds that moral hazard is an opportunistic price response. Insured person acts like the price of medical care has reduced exogenously in the market. This ex post moral hazard is welfare decreasing because the value of the additional medical care consumed is less than its cost. This welfare loss argument is first made by Mark Polly in his 1968 journal paper. So figure 1 shows Polly's classic argument. M on the horizontal axis is quantity of medical care, and this one, price of unit of medical care, is on the vertical axis. A consumer's demand for medical care is represented by D. This is demand curve. And the hospital's supply by MC, the marginal cost of medical care. Without insurance, the market price P equal to 1 is normalized 1. Then medical care, okay, P, medical care MU is consumed. With the insurance, paying all the cost, the price drops to P equal 0. Then medical care MI is consumed. So the moral hazard is represented by MI minus MU, which is additional cares due to the insurance. The value of additional care, medical care, is measured by area under the demand curve, A, MI, MU. And the cost is measured by area, A, B, MI, MU. So the welfare loss from the additional care is a triangle, A, B, MI, okay, which is called deadweight loss caused by market inefficiency. Okay. Because of this theory, health economists have focused on the policies that would reduce inefficient consumption at the margin. Okay. Cost-sharing devices such as co-insurance and co-payment are always preferred by health insurers. Let's look at the figure 1 again. Imposing a co-insurance rate C raises the insured consumer's price from 0 to CP, and the medical care is MC is consumed. The moral hazard reduced from MIMU to MCMU. The welfare loss is also reduced from ABMI to ACD. This is the conventional theory of demand for health insurance and policy implication. Then let's see the Nyman's new theory. Nyman's theory presents an alternative view of moral hazard in the context of private health insurance. He pointed out that the conventional theory, which is viewing health insurance as a price effect, has overlooked the origins of health insurance contract as a vehicle for transferring income to the ill. He argues that health insurance is purchased because consumers want to transfer income from the healthy state to the ill state. Because of this income transfer, those who become ill purchase more health care than they would without insurance. For example, they may purchase an expensive life-saving procedure that would otherwise be unaffordable. This additional medical care is the income transfer effect of insurance. This moral hazard can be decomposed into an efficient portion and an inefficient portion. A fundamental ambiguity exists in the welfare implication of a moral hazard. Economists have always suspected but could never voice because they did not have the appropriate theory to explain it. In fact, Mark Poley, one of the architects of the conventional insurance theory, recognized this ambiguity in his 1983 paper. He pointed out that his original theory of moral hazard welfare loss was intended to apply only to routine physician's visits, prescriptions, dental care, and the like, and that the relevant theory, empirical evidence, and policy analysis for moral hazard in the case of serious illness has not been developed. This is one of the most serious omissions in the current literature. However, this distinction between common illness and serious illness has been lost on most health economists. For example, health economics textbook writers continue to present moral hazard as being unambiguously welfare decreasing, and health policy analysis continue to use the conventional theory in developing their recommendations for optimal cost sharing race, and other policies designed to reduce healthcare costs. Ivan provides a simple but very insightful example. With this example, he attempts to remove any ambiguity about the welfare implications of the moral hazard by assuming that insurers actually transfer income to an ill person in a lump sum when the ill person is diagnosed with covered ill. Let's say Lisa, 42 years old woman, is diagnosed with breast cancer. She has 3 medical cares to choose from. Without insurance, she would purchase only a mastectomy for $20,000. With insurance that pays for all her cares, so she would purchase a mastectomy and breast reconstruction and plus 2 extra days in hospital to recover for $4,000. Additional cares purchased with insurance, moral hazard by definition, is represented by the breast reconstruction, okay, and the 2 extra days in hospital for 4,000. Okay. Okay. In order to determine whether this moral hazard is efficient or inefficient, suppose Lisa receives a lump sum payment of $44,000 from her insurance company when she is diagnosed with breast cancer and see what she would purchase. Assume that with her original income plus $44,000, she would purchase the $20,000 mastectomy and the $20,000 breast reconstruction, but not 2 extra days in the hospital for $4,000, because she could have purchased anything of her choosing with the additional $44,000 and chose to purchase the $20,000 breast reconstruction. We know that this portion of moral hazard is welfare increasing and efficient. And because she did not purchase 2 extra days in hospital, we know that this portion of moral hazard is welfare decreasing and inefficient. Therefore, this moral hazard can be decomposed into an efficient portion and an inefficient portion. Now I'm graphically analyze this income effect. Figure 2 shows some graphical analysis. Looks a little bit complicated. Using the yield consumer's budget line and indifference curve for the consumption bundles of healthcare M on the horizontal axis. Okay. And other goods and services Y on the vertical axis. And this graph shows the optimal consumption bundle of M and Y for the 3 cases just shown in previous slides. In the Lisa's case, without insurance, optimal consumption is MU, YU, where budget line is tangent to indifference curve, and with insurance, but with C, coinsurance rate, which makes the slope of a budget line flatten, then optimal consumption is MI here, where flattened budget line is tangent to indifference curve. If the ill consumer receives a lump sum payment from the insurer when she is diagnosed with cancer, optimal consumption would occur at MCYC because income transfer effect makes the budget line shift to the right and increase in consumption of M and Y. Therefore, we may know the total net moral hazard MI, MU can be decomposed into an income transfer effect MC, MU, and pure price effect is MIMC. In his book, Nyman estimates that the value of moral hazard consumption is found to be 3 times greater than its cost. And he suggests that income transfer effect dominate price effects, and therefore the moral hazard is welfare increasing. For more detailed explanation, please see his book. As we just saw in the previous example and graphical analysis, contrary to the conventional theory, the Nyman theory, in Nyman's theory, moral hazard is not always bad. Therefore, the Paulus prescription would be different. First, Nyman's theory suggests that cost-sharing devices should be applied sparingly because co-insurance or co-payment is likely to result in a smaller reduction of the welfare loss and a larger reduction of the welfare gain. Second, under conventional theory, high health care prices are not necessarily considered bad. In fact, a few economists have argued that high prices should be encouraged because they reduce moral hazard, and any reduction of moral hazard is a welfare gain. Nyman suggests that public policy should focus on reducing high prices in order to reduce health expenditures. This high price poses an even greater problem for the uninsured. The high prices they face often prevent any use of health care at all. Third, Nyman's theory argues that health insurance generally makes the consumer better off. Therefore, the subsidies that encourage consumers to purchase insurance voluntarily or national health insurance program would improve society's welfare. Nyman is one of vocal supporters of health insurance reform in the US as known as Obamacare. Let's move on to Guy Thomas' argument on adverse selection. Insurers typically argue that regulatory limits on their ability to use genetic tests will induce adverse selection. They say that this has disadvantages, not just for insurers, but also for society as a whole. That is, if risk classification is not possible, insurers have to charge a common pooled price, then people with higher risks relative to average price would buy more insurance, and people with lower risks would conclude that the product is overpriced and thus reduce or forego the insurance. As a result, the average cost of the insurance would increase, thus pushing price up. Then people with lower risks would continue to leave the market. This phenomenon is labeled as an adverse selection spiral or death spiral. Eventually, insurance markets fail. Insurance textbooks typically represent adverse selection as a severe problem in all insurance markets, which should always be avoided or minimized. However, Thomas is critical of orthodox theory of adverse selection. step back for a moment and think about what adverse selection actually means. Higher risks by more and lower risks by less. It means that insurance tends to be bought by people who need it most. From a social viewpoint, why is this bad? It is hard to find an answer. Adverse selection also leads to higher average prices and fewer people insured. Is this a bad outcome for insurance in society? Thomas insists that it is not always bad. What this adverse selection argument overlooks is the shift in coverage toward higher risk, those who need insurance most. If this shift in coverage is large enough, it can more than outweigh the fall in numbers insured, so that loss coverage is increased. Therefore, the right amount of adverse selection is a good thing because it increases loss coverage. What is loss coverage? The concept of loss coverage is Thomas's main innovation. Loss coverage is defined as the population's expected losses compensated by insurance. Loss coverage is a good metric for assessing how effective insurance is because compensation of loss is the main social purpose of insurance. When insurance is compulsory, for example, third-party liability for drivers and national health insurance in South Korea, loss coverage is conceptually 100%. Thomas's argument can be illustrated by the toy example. Consider a population of just 10 risks, say lives, with two alternative scenarios, no adverse selection and some adverse selection. In the boxes, each H, capital H, represents one high risk, and each L represents one low risk. The population has the typical predominance of lower risk. Therefore, population consists of 8 lower risks, each with a probability of loss 0.01, and 2 higher risks, each with a probability of loss 0.4. In each scenario, the lives in the shaded area denotes those covered by insurance. In scenario 1, where perfect risk classification is possible, then risk differentiated premiums are charged. Higher and lower risk groups each face a price equivalent to their probability of loss. That is an we call actually fair price. We assume that the demand response of each risk group to an actually fair price is the same. Exactly half the members of each group buy insurance. The shading shows there are total five risks by insurance, 4 lower risks, 1 higher risk. The weighted average of premiums paid in scenario 1 is like this, 0.016. Since higher and lower risks are insured in the same proportion as they exist in the population, there is no adverse selection. The expected losses compensated by insurance for the whole population, loss coverage, is calculated like this. So 50%. Let's move. Scenario 2. In scenario 2, risk classification has been banned, and so insurers have to charge a common pooled premium to both higher and lower risks. Then higher risks buy more insurance, and lower risks by less, the shading shows that 3 risks are now covered by insurance. The pooled premium is set as the weighted average of the 2 risks, so that expected profits on low risk exactly offset expected losses on high risk. This weighted average premium is 0.03. Note that the weighted average premium is higher in scenario 2, and the number of risks insured is lower than 3. This is an essential feature of adverse selection. But there is a surprise. Despite the average selection in scenario 2, the loss coverage under this scenario is higher than under scenario 1, 56%. Thomas suggests that scenario 2 with a higher loss coverage arises not despite the adverse selection, but because of adverse selection. Of course, if the adverse selection progresses beyond scenario 2 to its logical extreme, then the loss coverage will be lower than with no adverse selection. Thomas's key idea is that loss coverage is increased by degree of adverse selection. In other words, moderate, some adverse selection can be a good thing in insurance. Thomas argues that for policymakers or regulators, loss coverage is a good metric for the social efficacy of insurance. This is because compensation of population's losses is the main social purpose of insurance. Policymakers may therefore prefer some restrictions on risk classification that lead to higher loss coverage with some degree of adverse selection. The EU insurance industry complained noisily when the EU stopped the insurers from applying different prices for men and women. But in truth, this probably makes insurance work better. And so we might need limiting some other traditional risk classification, such as an age and disability discrimination, on the grounds that discriminatory pricing is necessary to stamp out adverse selection. In addition, this argument of loss coverage can be a reason for imposing regulatory limits on the usage of genetic information or big data. Okay. This is my conclusion. Today, I talked about information asymmetry in the insurance market from somewhat different perspectives. Two phenomena of information asymmetry, moral hazard and adverse selection, have been usually considered as a bad thing for society, causing market inefficiency and welfare loss. Today, I introduced two representative studies contradicting the conventional wisdom. Nyman suggests that much of additional health expenditures are actually efficient and good for society. And Thomas argues that insurance works better with some adverse selection. Although Nyman and Thomas's studies may not have wholly convinced academia and policymakers, they are at least enough to get us interested. We need more theoretical and empirical researches on these topics to find out efficient moral hazard and good adverse selection. But that's all for today. I wish you all attending this conference have a Merry Christmas and a Happy New Year. Thank you for listening.
Okay, thank you, Professor Lee. Okay. I invited Professor Lee for a special speech or special talk but as I expected, he delivered a really special talk, which is against our conventional knowledge or wisdom that the adverse selection is adverse and the moral hazard is hazardous, but he delivered something different from the conventional learning. Okay, thank you so much. Professor Lee also asked all of us not to ask any question right now, but if you have any question, please send him an email, okay, for further discussion. Okay, thank you so much. Now we are moving on to next special speech by the Professor Sharon Tennyson in Cornell University. She is lobbying for many academic society and also of course the university. And she is taking a job of the editorial chief editor of the IRFICO, which is the IRFC. Okay. Please welcome Professor Tennyson.
Thank you, Hongju. And I'd like to thank Professor Lee for a really fascinating talk. Those are not theories that I'm familiar with. I've certainly heard of both of those scholars, but I haven't read those works. And that was really, really an interesting talk. And I will definitely be looking more into the theories that were covered in that talk. I appreciate that. I am very happy to be here today. I want to thank KARMI for putting on this conference and for inviting me to speak, and certainly Professor Hongju Jung, who was the specific person who invited me. I'm very grateful to be invited to speak here and to have the opportunity to share my work with you. I've been doing some work on financial risk taking that I thought I would share today, since this is new work that I'm doing. I have to say in advance that the sort of ideas and the data are probably more interesting than the results that we get. But this is the first attempt that we've tried at doing this type of work. So work on this particular topic. So maybe we'll find more interesting results as we get further into the data. So I hope that you can see my screen.
Yep.
Okay, wonderful. So the paper that I'm going to present today is entitled, Is Risk-Taking in Our Nature? Genetics and Personality in Financial Decisions. And this research is joint with Professor Vicki Badelschmidt at Colorado State University, who does a lot of work on financial decisions. Professor Lisa Posey at Pennsylvania State University, who does a lot of work on genetics, and myself, who was brought in very generously by these co-authors to share in this project. So what we do in this paper is we take advantage of recently available data in large data sets on individuals' personality traits and genetic markers, and use these data in conjunction with more traditional economic variables that are used in studies of financial risk-taking, to see whether or not these innate characteristics represented by personality traits and genetic markers have some effect on financial risk-taking when we add them into these models. So this is sometimes called a nature versus nurture debate. What is it that's driving people's behavior? Is it innate characteristics such as personality and genetic predispositions, or is it environment and experiences represented by their upbringing and their previous life experiences? And if we learn much more about nature versus nurture and the inputs that they have into financial decision-making, insurance decision-making, other decision-making, this can eventually potentially have implications for policy and also for financial education. So the data that we use in this study is from the Health and Retirement Study panel data set in the United States. So the HRS, as we call it, is a nationally representative survey of older households. So in each year of the panel study, households where the primary respondent is over age 50 answer a variety of questions. It's a very rich data set about their financial situation, many decisions that they take, their past life history, their family situation, work history, retirement plans, and so forth. So it's a very rich study that's used in quite a lot of research. We use this data set for several specific reasons. First of all, because of this rich source of information about households' financial status and financial decisions. Secondly, because this is one of the data sets in which a subset of respondents are asked questions that allow the survey constructors to develop markers of their personality traits. And also they take DNA samples from a subset of respondents so that they can develop DNA markers in the data set. A third reason that we use this data set in our study is that personality traits can develop and change somewhat over time. But by the time people are 50 years old, studies have shown that personality traits are fairly fixed. And so we're dealing with a mature population, and we don't have to worry that personality is something that's fleeting or transitory in this data set. So the areas actually, maybe I need to say something more here. If I can try and go backwards. I want to emphasize as well some limitations on our sample. So we restrict, the HRS data doesn't stop at age 50, doesn't stop at age 75. They track people until they're deceased. We limit our sample to those who are between ages 50 and 75 because we want to avoid questions arising from how people's financial decisions might change as they become very elderly, either because of declining health or expectation that they won't be living much longer. And so we're looking at this mature population from ages 50 to 75 who should have stable personality traits, should have relatively good accumulation of wealth and stable life situation and financial situation. And we limit the sample to those who have household wealth of at least $10,000 so that financial decision-making is something they would be expected to be actively engaged in. And we limit the sample to those who have less than $10 million of wealth, just because those are fairly rare households in this sample and therefore wouldn't be at all representative. Okay. The other thing I should mention is that we limit the sample to households in which the respondent we're tracking is of European descent. And that's because we're using the DNA genetic markers. And it's been shown in studies that these types of genetic markers are reliable only within populations that are representative of where the original data were taken from. And in our case, that's people from European ancestry. So these are the types of questions that we can add to with the research process that we have. Okay, we're interested in looking at whether risk tolerance measures are useful in explaining financial risk-taking behavior. We're also looking at whether there are cohort effects on financial decision-making or financial risk-taking in these data. And then as is emphasized in the title, we are also looking at whether personality traits have an effect on financial decision-making when we add them to traditional economic models. We're also looking at whether genetic predispositions have an effect on financial decision-making when we add those into more traditional models. So when we look at this question of risk tolerance, can we see a relationship between risk tolerance measures and financial risk-taking? Well, of course, if we had knowledge of someone's actual risk tolerance, the answer would have to be yes, right? We know their risk tolerance is going to be affecting risk-taking behavior, so there wouldn't be a question to be asked here. The question arises, though, because we don't know what someone's true risk tolerance is. We have measures of risk tolerance, but those are constructed measures, right? People come up with ways to measure or approximate people's risk tolerance. And it has been shown in many studies that some of these measures can be somewhat problematic. Okay, so what we're really asking here is, can constructed measures of hypothetical risk tolerance that are included in this survey be used to explain financial risk-taking behavior? So the measure that we're going to use for risk tolerance is the so-called income gamble question. And this is not something that we came up with. This is something that's been asked in the HRS for a long period of time. But the income gamble question is asking someone about something about a scenario which is meant to be sort of realistic for them. So they're giving a hypothetical answer, but the question is given enough substance that it's thought to trigger people to really think about it, right? So you're asked to imagine that you're the only income earner in the family. You need to move because of some minor medical concerns. And in doing so, you have to choose between two possible jobs, and they have different income risks associated with them. Okay. And so by asking people questions in which the income risk is varied, so this is the first scenario that people are asked, and then the income gamble question changes the relative odds of the two different jobs and looks for where people will switch between taking the first job and the second job. And by looking at people's calibrated responses to those questions, they then give people a risk tolerance ranking or category from 1, 2, 3, or 4. Okay, so this is a measure that was developed and tested by Barsky, Juster, Kimball, and Shapiro, and has been used a lot in research by Kimball and by others. So what we do in our paper to try to isolate the pure measure of risk tolerance from other factors like gender, age, and so forth, education in particular, is we run first a preliminary regression. People are asked this multiple times in this survey because it's a panel data. And so we first look at individuals' responses to the risk tolerance measures, and we regress those against their individual characteristics, and in our case also their genetic predispositions that we can measure and their personality traits. And what we do, and to include in our estimated model, is we include the residual from this first stage regression as our measure of risk tolerance. And so what we're trying to do is isolate something that's associated with this hypothetical risk tolerance that isn't related to the other factors that we're going to include as control variables in our regression. We're also interested in cohort effects, which are difficult things to measure, especially when we're following people over time as they age. So a cohort effect is trying to look at whether people who were born at a similar time period have common responses or common patterns in their decision making, right? So this is usually of interest when a cohort may have been subjected to some particularly large shock in their lifetime, right? So there's been lots of interest in older cohorts who were young during the Great Depression of the 1930s, for example. I expect in future we will have studies of cohorts who were coming of age during the COVID-19 pandemic, for example, to see whether or not a common exposure to a major event results in long-lasting differences in personality or decision-making and so forth. Okay, so we're going to try to represent a cohort effect in our study as well, and what we're going to use as our cohort effect here is the standard deviation of returns on risky assets in the market during the time period that the individual we're looking at is between the ages of 18 and 30. Okay, so we're trying to look at when you first were entering the job market and possibly paying attention to financial markets. What did stock markets look like? Did they look risky or did they look less risky? And we're going to investigate whether that has any effect on your financial risk taking later in life. As I said, we're also going to look at personality and whether personality traits affect financial risk taking. So psychologists have been studying personality for a long time, and what they have evolved to over time is a common agreement in their field of several personality traits, which in combination can explain a lot of the general variation across individuals in personality. And they call these traits the big five personality traits. And the big five personality traits are conscientiousness, openness to experience, extroversion, neuroticism, and agreeableness, right? So they're all capturing something slightly different about an individual's personality characteristics. And in combination, and in varying combinations, have been shown by psychologists to explain lots of differences across people, okay? What we're going to be interested in are using these personality traits in our regression models of financial risk taking to see whether or not these innate characteristics of neuroticism, extroversion, agreeableness, openness, and conscientiousness are related to people's financial decision-making behaviors, right? So the way that psychologists measure these five personality traits is by asking people a battery of questions. I think it's something like 46 different questions, and each of them, the answers to those questions, people give a rating that says, you know, I'm not like this at all, I'm somewhat like this, I'm somewhat, you know, I'm a lot like this, right? They ask people to sort of say whether or not they agree that they exhibit certain types of tendencies in their behaviors, and then those are grouped into measures of the degree of neuroticism, extroversion, agreeableness, openness, and conscientiousness. Okay, so we have measures for the individuals in our survey of these personality traits, so we're going to include them in our estimates. When we get to genetics, this is something that's a little bit newer and has been made possible by the mapping of the human genome. So this is not, again, anything that we're constructing ourselves. This is something that's been added into the HRS by those who study genetics, and is made possible by having respondents to the HRS, a selected subsample of them, provide a DNA sample, and using that DNA sample to be parsed out into polygenic scores for particular types of traits. So I think, yeah. We have some slides. If Lisa were presenting this paper, she would tell you much more about the GWAS and the PGS and various SNPs and so forth, and how these things are constructed. This is not my forte, but the basic idea is that how these are developed is there are initial scientific studies that use hundreds of thousands and maybe millions of individuals, collect their DNA characteristics, and use essentially big data techniques in the realm of science to link individuals' characteristics to various portions of the genetic code. Okay, now complex traits, especially things like, you know, behavioral propensities, are affected by many, many genes. And so this is not simply identifying a gene for something, but trying to identify all of the possible parts of genetic material that contribute to a particular type of propensity. All right, so there's lots and lots of both scientific research and really statistical research that goes into developing these so-called polygenic scores. Okay. This is why we're using only a subsample of the HRS of people who are of European ancestry, because we want to include some of these polygenic scores for various relevant or potentially relevant traits. And the studies in the science show that there are distinct differences in how genes are assembled to affect various traits based on ancestry group, right? Our genetic code in general is quite similar across different ancestry groups. So it's not the code per se, but it's how the genes combine to affect these traits that's different. And so the data that we have are reliable for those of European ancestry, and that's going to be the limit of our sample then. So we're limited by the PGS scores that are included in the HRS. And so we have 3 genetic predispositions underlying personality traits, right? So in addition to a direct personality measure for someone's extent of neuroticism, we also have a genetic propensity score for neuroticism that's derived from their genetic code. Similarly, for extroversion, we have both a direct personality measure and an underlying measure of their genetic predisposition. And for openness to experience, we have the same thing. We don't have it for all 5 of the personality traits, but we have it for 3 of them. We then also include 2 additional genetic predispositions. One is for educational attainment. This is the PGS score that has been used in the most economic studies, and it's been shown to be correlated with lots of different types of behaviors. Keep in mind that this is just a genetic predisposition to seeking additional education. We'll also control, just as we do in the case of personality, we'll also control for the person's actual education level. And there is also a PGS score for risk tolerance. And so again, we're going to control for the genetic propensity towards a higher risk tolerance, as well as the results in the HRS that are measuring directly the individual's responses about their own risk tolerance. Okay, so everything that we're measuring in turn with something that represents a genetic predisposition, we're also going to be controlling for observed data from that individual on that same trait. And so this is how we're going to try to determine whether or not genetics play a role in financial decision making, because we're going to be adding in the genetic predispositions in addition to observed data on the traits that we have genetic data on. So this is our basic empirical methodology. We're going to look at several financial outcomes or financial decisions for the individual. And we're going to run what I'm going to share today are logit models of the probability that a person makes a certain type of financial investment or a financial decision. And we're going to run a regression of that on their observed risk tolerance, their observed personality traits, their observed socio-demographic characteristics, the control variables that we have listed here, as well as this cohort effect, the standard deviation of risky asset returns when they were younger. Okay, we limit our sample to the financial respondent. That's the person in the household who says they're most likely to make financial decisions and are most knowledgeable about the choices that they make. And the results I'm going to share with you today are random effects logit models. These are our descriptive statistics. There's probably not much that you can see here or what would be of interest to you here, other than to point out to you that we have 34,401 separate observations. Okay. So just going to share a few of the results here. First, we're going to look at the decision to hold risky assets. So we look at a 0-1 variable. Does this person invest in risky assets? And we define risky assets to be stock market investments and business investments, having your own business. Okay, we could define it other ways, right? This is just what we've chosen to look at. And so we run our models for the combination. So has risky assets means you either hold stocks or have your own business or both. And then we separate them out into looking at, do you hold stocks and do you have your own business? Okay. A few results that we'll highlight here on the left is that risk tolerance, even after controlling for genetic propensity, seems to be important. So measured risk tolerance seems to predict investments in risky assets, stocks, and business alike. Genetic propensity for educational attainment is also positively associated with owning risky assets and with owning stocks. Genetic propensity for neuroticism decreases the likelihood of owning risky assets and the likelihood of owning stocks. And what seems to be more representative in terms of innate characteristics that are related to owning a business is the personality trait of extroversion. So those who score higher on the personality trait of extroversion are substantially more likely to invest in a business, to own their own business than others. One thing I want to mention here, in case you're actually looking at the numbers, is that because these are logit models, we're reporting the odds ratio. So all of the coefficients are positive. The demarking line between whether something has a negative effect on the dependent variable or a positive effect on the dependent variable is 1 in the odds ratio, as opposed to being negative or positive, right? So an odds ratio greater than 1 means, for example, for risk tolerance, 1.14 is the odds ratio for has risky assets. That means that someone with a 1 unit higher score for risk tolerance is 14% more likely than others to invest in risky assets. And those odds ratios that are less than 1 suggest are indicating that that person is less likely to invest in risky assets. Okay. There are a couple of other things that I want to mention about these results here. We do see some cohort effects, in particular in stock ownership, so that those in their formative adult years who saw higher standard deviation in the stock market returns when they were between the ages of 18 and 30 are significantly less likely than others to invest in the stock market. So there is a cohort effect in terms of stock markets. Even after controlling for genetic predisposition, personality, and risk tolerance, women are significantly less likely to own their own business or invest in their own business assets than men. And again, even after controlling for personality traits and genetic predisposition, actual years of education are positively associated with investing in risky assets. So the second types of things we look at are more specific financial decisions. Here we're looking at a decision to have a credit card debt, a decision to hold a mortgage at a relatively later stage in life between the ages of 50 and 75, and a decision to have life insurance. And a few things that we'll point out in terms of the results is that credit card debt is highly associated with personality traits. So if you look there in the middle, the big 5 personality type scores, all of those are statistically significant, have different signs, right? So neuroticism, agreeableness, and openness to experience are positively associated with having credit card debt. Extroversion and conscientiousness are negatively associated with having credit card debt. But it's just really striking that this is what seems to be associated with credit card debt. Risk tolerance, polygenic score, as opposed to the risk tolerance, observed risk tolerance, even after we control for observed risk tolerance, or in addition to observed risk tolerance, we see that the polygenic score for risk tolerance is positively associated with having a mortgage when you're this age, right? So there's some genetic predisposition for taking risk that seems to be associated with having a mortgage debt at this age. Owning life insurance is positively related to personality traits of agreeableness and conscientiousness, negatively related to openness. And then finally, even after controlling for all of these personality traits and genetic predispositions, women are much less likely to have life insurance than men, which is consistent with national statistics in the US. Again, highlighting a couple of other things, we see the actual years of education is significantly associated with all 3 of these outcome variables, these financial decisions, even after controlling for genetic propensities and personality traits. And risk tolerance, even after observed risk tolerance, even after controlling for genetic propensities and personality traits, is significantly related to all 3 of these financial decisions or outcomes as well. So in summary, as I said, our results are, a kind of a mixed bag of interesting things. We don't have a big takeaway that something is always super important or something is never super important. And perhaps with additional study and refinements, we'll come up with something that's more of a big bang result. But we do find substantial evidence that personality traits are related to financial decision-making. And we also see that the genetic propensity for educational attainment impacts a wide range of decisions. We don't see consistently strong results for any of the other novel variables that we include in this analysis. But overall, what we find is that adding personality traits and genetic propensities to these sort of more traditional economic models of financial decision-making does add explanatory power and does provide significant associations with decision-making. So that's everything that I want to share with you today. I appreciate the opportunity to share this work with you, and look forward to the day when we learn a lot more in terms of outcomes and results from this type of research.
Okay. Thank you, Sharon. It was really interesting research to show the genetic information or genetic propensity influence the risk-taking behavior, including life insurance, the stock investment, and so on. Is there any question, short question to Professor Sharon Tennyson from the floor? Okay.
Great. Thank you for your attention, everyone.
Okay. Thank you again. And we are now turning to the next presenter, Dr. Ho Yu-kyung, who is a very active member of IFECO, and she is now in NYU in New York City, United States, as a special scholar. She is delivering a speech on the global trend in the financial consumer protection. Okay. Dr. Ho, the floor is yours.
Hello, everybody. Nice to see Professor Jung and everybody again. So I would like to share my slides with you.
Okay, please go ahead.
Okay.
You have 30 minutes to present.
Okay. Okay, so I thank you again for inviting me. Right now I'm in New York as a postdoctoral fellow at NYU, and I held positions as a director of Consumers Korea, a consumer organization in Korea, and also a council member of Consumers International, which is a group of international group of consumer organizations at the global level. So today I'd like to talk about generally finding a place, a good stable home for financial consumer protection at the domestic level and the global level. So at the domestic level, at the national level, we can see in the financial regulatory space, there are financial regulators that have multiple roles. They essentially, some central banks might be involved in financial regulation, or there could be another a separate financial regulator that's in charge of multiple regulatory goals, including prudential regulation and consumer protection. However, what we've seen in several nations, including Korea, the United States, the UK, is that there are fundamental differences existing between prudential regulation and consumer protection. So many countries, many international organizations, including the World Bank and scholars, and including Korean policymakers, have debated and are debating right now, even in South Korea right now. So what is the best institutional arrangement for financial consumer protection within the national domestic regulatory landscape? And then the second part of the presentation is going to be about at the global level. So there are these, what we call as international financial regulators, the World Bank, the IMF, BCBC, IOSCO, and they all are involved in standard setting or recommending some elements of good financial how financial regulation should be done at the global level. So at the global level, what we see is that prior to the 2008 global financial crisis, there is very limited cooperation and coordination between these various international financial organizations and bodies. And only after the crisis, we have become to recognize that, in fact, financial consumer protection and prudential regulation are interrelated and complementary. So after the crisis, what we see is a network of international organizations that have joined effort in working in this space. So first, at the national level, I'd like to explain how prudential regulation and consumer protection are conflicting with each other. So except for a handful of nations, in fact, in most nations, the regulators, the primary regulator for banks or insurance companies or credit card companies and securities companies are both in are both responsible for prudential regulation of these financial institutions and also for consumer protection. However, for some nations, about 5 countries or less than 10 countries in the world have a Twin Peaks model, which means that consumer protection is done in one separate agency and prudential regulation is done in a separate agency. So because consumer protection and prudential regulation are found to be in conflict with each other, those countries have decided to split the 2 goals into separate agencies. However, the prevailing model in the world is actually the integrated model, which means that the single regulator or the industry sector-based regulator is in charge of both aspects of financial regulation. So, so there are debates on whether or not these consumer protection functions should be done by a separate agency. But in order to assess those claims, I think we need to have a very clear understanding of what the rationale of these different regulatory goals are and what are the interventions, the tools, the resources needed to do financial consumer protection. So here is a chart that I've put down. It summarizes what I'll be discussing in the following slides. So I looked into the rationale, the interventions and tools and resources needed for different types of goals. So for prudential regulation, the rationale, the reason why we do prudential regulation is to keep the banks and the financial systems safe and sound, financially stable. Whereas for consumer protection, the rationale is very different. It includes economic rationale, but also it's related to other non-market social goals, distribution goals, and so forth. So we'll discuss this in detail in the following slides. So for prudential regulation, it's relatively single-minded. It's to keep the banks safe and sound. The rationale is that banks are unique because they are subject to certain types of risks, liquidity risks, and because banks have a liquidity creation function, they're systematically important and they can fail, and the failure of the banks can create unique externalities. So banks are inherently fragile because they provide liquidity to the economy by investing into illiquid assets through deposits. However, the banks transform the illiquid assets into liquid liabilities, which into short-term funding. So there's a liquidity creation function, and therefore the banks are just inherently unstable. And so the banks, because the banks only hold a fraction of the deposits as reserves. So if everybody goes to the bank at once and decides to withdraw their savings at once, the whole bank, the banks are going to fail, and it might affect a ripple effect where the whole financial system of any nation might fail. So that's why we have regulation, and that's why we have the specific types of regulation that are relatively similar across the different nations. Whereas for consumer protection, we can see that different countries have very different diverse types of consumer protection. So one type of a market rationale is to deal with information asymmetries. So the banks and financial institutions have a load of information, whereas the customers just don't know enough about the financial products or the quality of the financial institutions that they're dealing with. And more recently, there's an influence of behavioral economics in consumer protection. So the assumption is that consumers are not, in fact, rational and well-informed actors in the financial market. They're actually very biased in several psychological ways. And therefore, the market doesn't function as well as we thought of before. And then there's also the non-market rationales or social rationales that are very diverse across the globe. So in some nations, it's more about distributive justice to enhance home ownership around the different neighborhoods. It could be about gender inequality. It could be about enhancing student loans, enhancing education by affording more student loans, or it could be about protecting members of the military, or financial inclusion for the poor, the women, the elderly, and so forth. So it just financial consumer protection, financial inclusion, financial education, literacy. There's like so many different types of diverse things going on in this space. So it's very difficult for the regulators to effectively do their job. So, but one of the arguments is that prudential regulation and consumer protection creates conflicts because the nature of their goals conceptually or theoretically, they are in conflict with each other. And I call it the type 1 conflict, the goal conflict, which means that the goals are inversely related. So increasing one goal leads to the deterioration of another. So the example that I give involves the US Forest Service. So one of its goals is to enhance timber production, enhance the wood production. And on the other hand, it's also to protect wildlife, like protecting the owls that live in the trees, which would be cut down if timber production is increased. So in this case, the Forest Service faces a conflicting goal, a type 1 conflict. And in financial regulation, in the financial regulation sector, it means that, for example, the Federal Reserve, this is a website of the Federal Reserve of the United States, and it shows, we can see that what it does is its monetary policy and supervision regulation is very important. It's the primary mission. The primary mission of the Federal Reserve is monetary policy, but you can see on the right, there's a consumers and communities goal is relatively low priority. So the conflict means that consumer protection, enhancing consumer protection, which means that harsher enforcement policies could potentially harm bank profitability and deplete assets. So, and another aspect of where the conflicts or the differences occur comes from the different types of regulatory tools and interventions that are needed for the different types of goals. So for prudential regulation, it's like capital requirements, loan concentration, risk retaining levels are regulated by the institution, by the regulators. Whereas for consumer protection, it involves like disclosure, regulation, advertising. It could involve banning certain products or in the financial market. So one characteristic that we see in terms of intervention is that for prudential regulation, the style is more cooperative, and it involves more secrecy in the product. So in the yellow right box, how the bank supervision is described by academics is that like everything is secret. It's a secret law. I'm sorry. And secret law, secret policy, and there's like a club-like sort of like secret type of supervision that's going on in the prudential regulation realm. Whereas for consumer protection information, it's like the enforcement actions are publicized on their websites in order to enhance deterrence. There's a name and shame policy in the UK. And so they just involve different types of tactics and tools for these to achieve the goals. So for consumer protection on the left, it's more like a tough cop approach, policing the industry. Whereas for prudential regulation, on the right box, you can see the bank examiner smiling to the bank official, and just shows that different types of styles exist. And a third type of conflict comes from the different types of resources that are needed for these regulations. So for prudential regulation involves, in terms of human resources, involves like economics and finance majors, whereas for consumer protection, it has a more legalistic view. And so lawyers are needed to do this job. And the types of information that is needed for regulation is also, for prudential regulation, we're looking at statistics, numbers, accounting information, quantitative information that is drawn through the computer systems from the financial companies. Whereas for consumer protection, we need to look at the individual contracts between the financial institutions and the consumers. So we're looking at individual consumer contracts, complaint data, and community activities, consumer data from the consumer organizations, and so forth. And a third resource factor is that the financial industry is very well funded. It's normally very concentrated. Intense lobbying occurs in this industry, whereas for consumers, consumer organizations, they are dispersed, they lack a coherent voice, and so forth. So this creates a third type of conflict, which I call a resource conflict. So what happens in a single agency is that the agency is like competing for different types of resources. And what we usually see in many nations is a consumer protection goal has a very small number of people actually doing their job. So they're just always resource deprived, lacking the expertise or the knowledge to do their job well. So at the global level, what we see is, so prior to the crisis, we see these international financial organizations showing limited cooperation, whereas after the global financial crisis, the leaders have recognized that, in fact, financial consumer protection is interrelated with other financial regulatory goals, and thus we see an elevated status of financial consumer protection at the global level. So before the crisis, the main actors were the international standard setters called the Basel Committee on Banking Supervision, IOSCO, for IOSCO for insurance companies, and IOSCO is for securities companies, and IAIS for insurance companies. So the Basel Committee had several versions of the principles, but only in the 2012 principles they note that as a precondition for effective banking supervision, some elements of consumer protection is required. However, as we all know, the BCBS created the Basel Accords. They're most known for their capital requirements, and this is called it's regarded as one of the most successful effort where these international standard setters have actually been able to find some global harmonization in this stage. So the IOSCO and IAIS, they're clear that their supervision has some consumer protection, investor protection element for it. So the IOSCO, the Securities Commission regulator sets out in the principles that protecting investors is one of the main 3 objectives that the principles are pursuing. And the International Association of Insurance Supervisors focuses on insurer and intermediary conduct regarding the consumers in the sales of these insurance products. So we see a variation across the different types of international standard setters. And we also see a little motivation, very small motivation in terms of the international standard setters wanting to cooperate and coordinate among the different, the global financial regulators. So the reason for that is because I find that the retail finance markets are traditionally regulated locally at the national level. So there is not too much sense in the international standard setters trying to work and cooperate in this rather dispersed space. So what in a quote by an international law scholar says that financial regulators are generally hesitant to assert themselves as international actors, and they only want to engage in international standard setting when they are unable to fulfill their domestic mandates with unilateral regulation. But because retail finance markets are done locally, there is really no need to work in the international space. And another reason is that international financial regulation generally is considered as a soft law, And so the wordings of these international instruments is generally called like principles, best practices, codes of conduct. So it's not mandatory. There's no retaliation for non-compliance and so forth. And the principles and standards are generally are worded at a very high level of generalization. And also, especially in the consumer protection world, it's very difficult to assess if each nation has in fact met the principles, have implemented the standards as assessed by the IMF and World Bank in their reports. And also, if we look at the mandates and the jurisdictions of the financial regulators that work in this international standard settings, the central banks normally, they don't have consumer protection mandates in their laws, in their regulations. So they just don't, it's just not their job to work in the international space to enhance consumer protection coordination at the global level. And also the BCBS, the international standard setting body for banking regulation, the primary goal is not financial consumer protection. It says explicitly that it is the primary global standard setter for prudential regulation of the banks. So after the global financial crisis, we see not only the traditional, the BIS, the IOSCO IAIS working in this space, and the World Bank and the IMF, we see many more actors participate in the global space. So we see a higher level of recognition, the G20 and the Financial Stability Board, which is made of global leaders at the very highest level. The prime ministers and the presidents come together and decide what are the general rules or what's important in the global space. They recognized after the 2008 financial crisis that consumer protection, financial consumer protection is a very important goal. And as a result of that, the OECD, G20 come together and they produced a document called the High-Level Principles on Financial Consumer Protection. It was first established in 2011, and it's currently under review in this year and throughout next year. And next year in 2022, the OECD is going to come up with a revised version, maybe, of these high-level principles. So they're currently working on the revisions at this moment. And the G20 OECD task force on consumer protection was also formed. And what they do is they monitor, assess the implementation of these high-level principles. And they also have separate reports on digital finance, the aging population, behavioral economics, COVID-19 issues that all are concerned with financial consumer issues. And also the more well-established institutions, the World Bank and UNCTAD also have recognized at the higher level the importance of financial consumer protection. So World Bank produced documents in 2012 and 2018, the good practices for financial consumer protection, which is a very comprehensive document, has everything about how financial consumer protection looks like at the global level, and it compares practices and sets forth good practices across the different nations. However, it does say that it's only good practices. It doesn't word it as a best practice. So it also recognizes that there are very diverse practices existing across the world. The UNCTAD, the UN guidelines on consumer protection, which was stipulated in 1985, in the 2015 version, the latest version, includes a new section on financial services. And it says that member states should establish appropriate consumer protection enforcement policies and so forth. So we can see an elevation of financial consumer protection within the international fora. And we also see new organizations and networks arising in the financial consumer protection space. So FinConet, International Financial Consumer Protection Organization, was formed in 2013. it's a group of organizations of supervisory authorities that have the responsibility for financial consumer protection. And then within OECD, there's INFI, International Network of Financial Education. It's focused on financial education aspect of financial consumers. And we also see financial consumer protection being working together with other goals that exist for other agencies. So for example, CGAP, the consultative group to assist the poor, which main goal is to enhance financial inclusion, also includes financial consumer protection as a priority. And the OECD, as I have previously mentioned, before the crisis, it worked on finance and consumer protection both as separate topics, but now it works on financial consumer protection as another third independent topic. And we also see a growth of networks in this global space. So there is a global partnership for financial inclusion, where all the other international standards bodies come together to discuss financial consumer protection issues. And also a joint forum, which is a forum where they produce work where they compare the different types of, like, for example, the point of sale disclosures across the different sectors of insurance, banking, and securities. So the reason why they compare across the different sectors is in order to identify and assess the gaps between the different sectors. And so just to conclude, so after the crisis, what we see in global financial consumer protection is that we see an enhanced profile of financial consumer protection. We see more prominent organizations, the G20, the OECD working here. However, if we look at some of these agencies, the participation is limited in terms of membership. So for example, FinConet has only 26 nations as member nations. And also another limitation would be that the principles set forth after the crisis is that they're presented as a more generalized abstract language. They only word them as high level or good practices compared to best practices. They provide surveys, toolkits, and approaches, but it's not really like a hard set of principles that they require each nation to follow. So compared to that, the BCBS sets a minimum capital requirements, and the expectation is that nations should at least meet the minimum requirements, and to some extent, they have succeeded in creating some harmonization in this space. And they also have implementation deadlines, even though they're not met in some cases. At least they have some deadlines, but we don't see that type of a hard deadline type of thing happening in the consumer protection space. So I would say it's like even more softer than the soft law that we see in typical international financial regulation. And this again is coming because of the reason why consumer protection is not harmonized at the global level is that the market itself is primarily domestic, and it's often very politicized. So each different types of regulation often arises from a specific crisis or some sort of scandal or a consumer protection scam, consumer scam that happens in each nation. And the result is that we see a very variety of different regulations across the globe. And also regulators might have fundamentally different policy preferences, especially regarding issues that have distributive implications. So what the World Bank says is that there's a cross-country context that plays a major role in translating the good practices into specific circumstances. And country examples, legal references should be considered only as best, but should not be considered as best practices, and should not be transplanted wholesale to another country without specific consideration of what happens in each other country. And also another limitation is that what I could see is that the global work has focused on some less intrusive issues or some technical issues where there is like, where there might be less disagreement in these areas. For example, disclosure or subtech. Subtech means supervision plus technology, so specific digital technologies that are used for financial supervision. There's a great deal of knowledge sharing in this space, but it doesn't really tell each nation like what you're supposed to do or what you're not supposed to do in terms of legal requirements. And also financial education literacy is a relatively less intrusive form of a regulatory tool. So what the products that are made in this space is that it's intended to promote global learning rather than mandating requirements across the globe. However, I do feel that there's a great space that we can learn from each other, from global learning and collaboration that could enhance financial consumer protection across the world. So to conclude, seeking a more stable home for financial consumer protection, because financial consumer protection at the national level is generally challenged in terms of finding a stable institutional arrangement. It's often left behind of other financial regulatory goals. And at the global level, we see after the crisis that it has increased priority, but still the global landscape is still kind of patchy, and there's still lots of inconsistencies across the world, and we can still work in that space. So thank you for listening. You can reach out if you have any questions. Thank you.
Okay, thank you, Dr. Ho, for your nice review of the financial consumer protection in global sense, both in practice and the theory. Okay. Are there any question or comment on the Dr. Ho's presentation from the floor? She is now doing research at NYU in New York City, which is the center of the whole world in economic sense. So she is doing more and more research on the global consumer protection theory and practice. Okay. Thanks a lot. Now it's my turn to make my own presentation, but we are 26 minutes behind the schedule, so I have just 4 minutes for my presentation. Okay. I'm going to summarize my paper in a few minutes and then upload my file in our website so that you can see anytime you like. My presentation is about the Korean case. Although the Dr. Ho explained the global phenomena in financial consumer protection, I'm going to explain a bit about the Korean issues and the development in the financial supervision system in particular. So I'm talking about the hardware of the supervision system in finance in Korea. Basically, the Korea is a exceptionally successful case or country in the whole world in economic development. As we all know, we have developed our economic level within a very short period of time. But in terms of the financial development, we are lacking behind. So according to some review, the Korean financial system ranks around 80s, 82 or 83 in the whole world. So many people wondered why Korean financial system is so lag behind although many intelligent people work in the financial sector, financial market, financial industry, or financial regulation. So, and the answer, most of the answer concentrate on the way to regulate the financial market. So that is the government. As the Dr. Ho explained, there is a kind of the hierarchy of the policy goal of the regulatory goal in many countries. In Korea, the financial sector was regulated by the government from the top goal, which is economic development. Next goal is the financial sector development. The bottom goal might be the financial consumer protection for over 60 or 70 years. And according to the academic research, there should be two major goals of the financial supervision system, which is the stability and the fair competition and the efficient market of the financial system. And for this goal, the financial supervision system has a good governance with in terms of independence, accountability, transparency, and the integrity, also competency. And there are actually three optional ways to design the financial supervision system. The individual or separated system for banking, security, and insurance, or integrated system like in the Twin Peaks in Australia. So prudential regulation and the market conduct regulation are separated, or all unified system like in UK. These are three options. And every structure or the system has its pros and cons, advantages and the disadvantages. In case of the individualized, specialized system, the pros can be classified as this, and the disadvantages might be this. And importantly, there are also some pros and cons in the integrated system or unified system. Nowadays, since 1997, when the United Kingdom developed the integrated FSS, as many countries has moved to the integrated system or unified system. So they, many countries show these kind of advantages and the disadvantages. This comparison was taken from a paper of which I didn't cite because I just forgot the name of the paper and the author. And when I was reading these advantages and disadvantages, I think these perfectly matching, fairly perfectly matching the Korean experience. So one example is the after integrating Korean financial supervision agent into one, we see some moral hazard issues of the market participant and conflict between the several goals and so-called Christmas tree effect. Christmas tree means that many things in together. The monopoly without competition between institutions also happening in Korea, excessively powerful, too powerful, authoritative, and conflict of interest leading to one party to hope, as Dr. Ho said. Of course, there are some pros. And in case of Korea, we have a couple of issues. Number one is the double peak, not twin peak, system of the Korean FSS, financial supervision system. We have a governmental body regulator and a semi-public body under this regulator. We have FSC, Financial Service Commission, Financial Service Committee, and the Financial Supervisory agent or something. So we have double peak, not twin peak system in Korea. And unfortunately, they have different goals. The FSS focuses on the consumer protection and the prudential regulation, while this upper level regulator has two goals: to develop financial service sector as well as to supervise FIS through the FSS. So the FSC has two conflicting goals. So there should be a conflict of interest, like these two-headed animals. And issue 2 is the political dependence, which is also discussed by the Dr. Ho. Okay. Korean government, headed by the president, has a strong control or grip of the financial sector to utilize for their political system or political agenda to be implemented. So financial system have been used by the president for their policy initiative. So political dependent is quite severe issue in Korea. And so industrial policy, monetary policy, and supervisory policy should be handled by separate organization or for separate goal, okay, which has not been done in Korea yet. And it is desirable for financial supervisory authority to take a position centered on only one purpose, which is the financial consumer protection, who are subject to limited competence. But Korea financial supervisory agent, especially FSC, is placed between the financial company and the financial consumer. Recently, the head of the FSS announced that the FSS should not just focus on the financial consumer protection. Rather, the FSS should support the financial service industry, okay, which is against their mandate. He came from the FSC. So there is some inconsistency in their behavior and the goal across the financial regulators. So my argument is to have independent and the more accountable, more transparent, and more competitive financial service regulator or supervisory agent. And nowadays, we will have a presidential election within next 100 days. So right before the presidential election, the Korean academic society or the expert or the parties concerned with the financial regulation have a hot debate over the new structure of the financial regulatory regime or the system. So we are on the time now again. So yesterday, we also had another meeting or the debate at the National Congress for the new design of the financial regulatory system. So we are looking forward to innovation or the renovation of the financial supervisory system in Korea for better future or the enhancement of the financial system, which should be matching the level of economy in the global society. Okay, thank you. Any question from the floor? Okay, then actually the morning session is over now, although we are still at the 11 a.m. From now on, we will have a presentation. We'll have 10 presentations from the ASEAN young scholars with their recent research guided by the GIPRC SKKU. And the ASEAN session will be moderated by the So-Young Lim. She is going to be a doctor in a few months. And before the ASEAN presentation, I would like to have the special congratulatory remark of the president of the Yangon University, Myanmar, the Professor Dr. Tin Thuy is supposed to make a short congratulatory remark for all of us, but unfortunately, she is occupied with many other important missions. So the Dr. Tin Thuy is replacing her speech on behalf of the rector or the president of the YUE. So she is now here to make a congratulation speech for all of us. So please welcome Dr. Tin Thuy.
Okay, thanks, Professor Hunju Jan. Okay. Good morning, Mingalava, to Professor Hunju Jan and all attendees. First of all, may I introduce myself? I am Dr. Tin Thuy, a professor and head of the Department of Commerce from YUE of Myanmar. So I'm very truly grateful to have the honor of saying a few words for the congratulation the KARMI conference today. So on behalf of my president, Dr. Tin Thuy, who is the standing with me, the rector of Yangon University of Economics, I want to say big congratulations to the organizer, Professor Hunju Jan and the group. So I want to say that you can hold the conference successfully while facing this difficult times of the many issues, the health problems. In fact, the finance industry is very important and very so many issues, and with the challenging industry with so many issues. So the research output very contributed to the financial sector of the development of the country. So I also very appreciative to all participants of the researchers for their resilient efforts to take part actively in the preparation of this conference. So finally, I would like to conclude my speech by wishing all the participants achieve the greatest success in their financial areas and contributed more than now for the interest of the respected university and also for the country financial sector development. So thanks a lot for your patience attention. Thanks. Okay.
Thank you, Professor
Okay.
Tin Thuy.
Okay. Nice to meet you.
Okay, nice to meet you too. Okay, now I'm turning to the Ms. So-Young Lim for her moderation of the ASEAN section.
Okay.
Hi everyone. I hope you enjoyed our morning session. And from now, we will have a ASEAN session, and we have 9 presenters from ASEAN country. And lastly, I will be a presenter about my survey. And we have 9 ASEAN researchers and Seonggyungan University Global Insurance and Pension Research Center. We have been this ASEAN research program. We have been organizing this program like since 2018. And this year we have nine researchers. And for the first one, Rindara from National University of Laos, she will present about her paper. And the title is Insurance Buying Behavior During COVID-19 in Laos. And Rindara, if you can share your screen, please share your screen and start your presentation.
Okay. Thank you. Thank you, Soyoung. Okay, first of all, I would like to say thanks to every support, very kind and warm from SKKU. Let's okay. Okay, can you see my screen now?
Yes, we can.
Okay, thank you. And thank you for Professor Ho Chu-jung that gave me a lot of chances, and this also a good opportunity for me, like learning a big class, a global class. And thank you for bringing me here. And today I'm going to present about the insurance behavior during the COVID-19 in Laos. As we can see, I think every country can feel the pandemic of the COVID-19, and the number of the infected and the death cases are increasing. Even in Laos, which is in the late 2019, the number of infected only 2 digit, but now we come to the 3 digit, and it's going to be 1,000 a day today. Yeah, so this is a big chance to many business and also into the insurance industry also. And we started to have the insurance company that go into the life and health products not many years ago, a few years ago. And normally in Laos, we are focusing on only the property, especially the vehicle insurance. And a few years ago, we started to have the life insurance and healthcare, it's have more competitor or more insurance company that jump into this sector. Yeah, and you can see in the pie chart below, it is about the 50% of the insurance company that have the general and life insurance, and only 14% that have only life insurance in Laos. This is the number of 2020. And lately, because of the number of the infected and the death cases in Laos increasing, so the new products of the insurance has come out, and people concerned more about the health and life insurance. However, there's still some constraint about the financial. So some were concerned about their pocket money or their financial before they buy the insurance. So this is the point that why I came out with the objective to study the consumer insurance buying behavior during the COVID-19. And the methodology here is going to use the questionnaire, because due to the situation, so I use the online questionnaire and with the multiple choice question, and calculated with the unknown population by to 0.05 earlier. So it should be 384 sample or 400 sample, and the questionnaires is related to W8 question from reviewing others paper in the study is going to be analyzed with a descriptive statistic, very simple one, like a frequency, percentage, max mean, and standard deviation. From the result, the collected number, we can get a lot of responder and respondents, and we can conclude the respondents of 424, 424 sample, and we can categorize their age by less than 25 and cover the most. It is 49% is from between 26 to 35 age, and the female is only 47 and male is 53. When we cluster the location or where they live, we can see that mostly live in central part of Laos, which is in Vientiane capital, Vientiane province, and Savannaket, Baric Kham Sai, and Khamon. And here is the central part of Laos and a little bit on the northern and the south. And they mostly live in the urban area, 76%, and then 20% live in the suburban. For education, mostly a bachelor degree, around 60%, and the master degree is 31%. For the other, is mean like high school and primary school and lower. And they're major because when we distribute from friends and students, so mostly would be business and economics major. However, we still have some major too, like agriculture, legal, and engineer, and literature in others. Mostly they are government official, which cover 62%, and the income per year is ranked between 50 to 200 million kip a year. The average is about 300 million. And also, most of them are married. 58% married, and single is covered 41%. However, if we made it classify it like a married, just like a new couple, something like that, because they only have the family member only, like only their couple, only the couple, which that leads to the people in the family less than 5 people is the most, and then between 5 to 10 people is come the second. And this show that in Laos we still have a very unique like a nuclear family. And for the when we ask about their insurance policies, yeah, 58% say that they have the insurance policy, and the type is varies, and some have 2 or some have 3 type of insurance. However, the most percentage that cover is vehicle insurance, and the other like life insurance still come the third, and others here is concluded in many like education or the farming. Actually, farm still not many in Laos. Okay, and compulsory social insurance, actually for the government it should have a lot, but I think it's like they don't realize or don't use it a lot, because some have the social insurance and they need to have more other type of insurance with the private company. Yeah. And here is the buying behavior. Yes. When we ask about do they buy a new insurance policy during the COVID-19, and the only 10% of the sample say yes, and the other 90 just say no. And this is the insurance company that they buy from. Yeah, mostly they buy from the existing company, almost 60% that buying from the existing company, and mostly buy from the agent. And the second is from the bank, as the bank also has the counter service for the insurance. And this is all the type for the 10% that saying they buy the new insurance policy. So I classify it as you will see that they still buy accident insurance as the number one, is a 44%, and then another is the COVID-19 insurance, which is the new one. And the number of COVID-19 insurance is increased when the number of the case of infection increased too. This can be proved with Ms. Solita. And this is the who get the benefit from the insurance policy, and it is oneself come number one is 51%, and then parents will be the second. And now, who has the influence to the decision making of buying a new insurance? Mostly oneself decision. Yeah, because we have male 58%, and they mostly the family head, or the chef of the head of the family. So, and also women. Yes, and the second come here is the couple. They have the consult to each other, and the information search for information of the insurance they search both from get information from the agency and from the internet or the online channel. And also the third one is from the bank counter service. And the reason of buying a new policy is because they want to reduce the family's financial risk, by transferring the risk to the insurance company. And then they want the insurance to be like a secure for their family. Yes, yes, this is a type of risk that people always faces when they face something uncertain like in this COVID-19. And the time of new the term, or how long do they do the insurance, it is on the newly like less than 6 months, and some are more than 18 months. And this is how do they pay and how they get back. Yeah, the protection value is between 10 million KIP to 50 million KIP. If compared to dollar, you can divide it with 10,000 KIP per dollar on average. And this is cover 44%, and the neck is more than 100 million is 24%, and the maximum cover is 3,600 million KIP, and the minimum is a million KIP, or they have to pay less than 100,000 KIP is the most 39%. Yeah, on average the payment is for the premium is 2 million KIP. And here's come to the reason for the person that who don't want to buy the new insurance, because they have the financial constraint, as the income is lower and the expenditure still remain the same, or some say that the expenditure is big enough now and they don't want to add in any expenditure. And that's the main constraint for this. And when we ask about the future expected from the insurance, this is the whole respondent all saying that they might maybe buy the travel insurance that cover with the COVID-19 is about 68%, and for the COVID-19 insurance cover, 54% is buying. And here are the conclusion. So we, from the respondent collector, they all mostly male, but it's half. And the age is between 25 to 35, and they're all living in the central part and mostly in the city, and mostly bachelor degree in education, and the major in business and economics. They have the income between 100 to 200 million KIP per annum, and then 58% are married, so less than 5. They have less than 5 family member in a house, and the they already have the policy insurance, 58%, which mostly in the vehicle protection. And for the buying behavior, we see that only 10% of the respondents that buy new insurance. And but I think there may be room to grow for the new buying if the COVID-19 still exists. And here 58% prefer a new policy from the existing company, that they show the trusted to the existing company and from the agency rather than the other channel. And also even though we see that accident insurance still be number one, and the second is coming is the COVID-19, which is covered 37%, and mostly self-beneficial and self decision-making on buying decision-making. And they have the searching information through the internet and the agency. And also all the buyer are newly, that less than 6 months, and they pay the premium less than 500,000 KIP per annum, and the cover is about between 10 to 50 million KIP. The reason that they're not buy, this is going to be the challenge to the insurance company. That is, the expenditure is over than the income. And the insurance product that cover COVID-19 still be interested to the consumer. Yes, that is come to the end for my presentation. Thank you for your attention, and please feel free to add in for any comment. Yes, thank you.
Thank you, Linda, for your for sharing your research. Is there any question on the floor? If you have any question, please unmute your microphone and ask your question to Linda. Okay, personally, I have one question to you, Linda. So you mentioned that some of people, they use online or mobile application for buying insurance in Laos. Is it common, or it is not common, but some people they use? And what kind of products they mostly buy using like online or mobile application? If you have any opinion, could you?
Yeah, thank you, So Young. Yeah, actually the mobile application is new to Laos too. But like is start maybe from the COVID-19 too, that they start to have the application on the mobile via the BCL banks or BCL application, which everyone can access to the application because they have the bank account with the BCL. And not many people use it, but they try to make an advertisement through many channels. And also it make a very quick access to the consumer, that they can continue their contact through the application. And also some application you can buy a new insurance, like a Lao Viet insurance company. They also provide the service from the application. Yeah, it is new, but they try to use the new technology, like try to make it to the lifestyle of the Lao. Also, Potential, which is the new company, insurance company in Laos, also try to boost up this activity too. So I put that's in one choice of the channel that they can use to buy it.
Thank you, Linda. Next, Dr. Han Hong Lu from sorry. So our second presenter is Dr. Han Hong Lu from Vietnam National University, and she got a PhD degree from France, and she will present about the impact of COVID-19 pandemic on life insurance demand, evidence from Vietnam. Dr. Han, if you are ready, please share your screen and make your presentation.
Good morning. So-Young, could you see my sharing screen already?
Yes, I can.
Okay.
Yes.
Thank you. Just a moment, please. Okay, so good morning, Professor Zhang, and good morning, So-Young and other participants today. At first, I would like to thanks to Dr. Professor Yang and for giving me an opportunity for presenting today, as well as giving me the opportunity to learn about insurance, because my background is more about finance, and for me insurance is quite a new field. So during last time I learned a lot from you and from other participation for the ASEAN program. So regarding the presentation today, I am going to present my recent study about the impact of COVID-19 pandemic on life insurance demand, and that is evidence from Vietnam. And I just found that my topic is a bit similar to Linda, right? But she applied for another market. So in fact, the idea of researching about the impact of COVID-19 pandemic on in Vietnam is because it comes like Vietnam were we at the beginning of the COVID-19 pandemic period. We are very proud of our countries because we prevent the spread of the COVID-19 very good. Like at the beginning, there are some period we are free, like no COVID-19 case in the society, and everything already get back to normal. But after that, still there are many cases, and recently, like 4 or 5 months recently, the numbers of the COVID-19 case in the society is increasing significantly, and we have many strict policy from the government try to prevent the spread of the COVID-19 pandemic. One of the reasons is because of the medical system and hospital system in Vietnam is not very good. Because we are still at the beginning of the developing period. So that is the reason why I come to the questions like, just a moment. I come to the questions like, after the COVID-19 pandemic happened, does it have impact on any decision of buying the life insurance of the people in Vietnam? Because in the earlier period, the insurance in Vietnam, even in Vietnam, that is very potential market, but in the mindset of the Vietnamese people, there are many people, they believe that buying insurance, especially life insurance, is unnecessary. But maybe after the COVID-19 pandemic happened, it could change their mind and may have impact on their behavior and may have impact on their demand about the life insurance. So that is the reason why I come to the research question about how does the COVID-19 pandemic impact on the life insurance demand in Vietnam. And behind the questions, there are two assumptions that I think about and I research about the impact of the COVID-19. The first one is it comes from the assumption regarding the relationship between the disposable income, the saving and the demand to buy the life insurance. So the first assumption is, in fact, the COVID-19 show that it have negative impact on the income of the people. And as the consequence, it will decrease the saving, right? And because the income and the saving is decreasing, it might have the decreasing the demand to buy the life insurance, because in general, normally people will think about buying the life insurance if they have more disposable income. However, because COVID-19 pandemic is relating to the people health, right? The number of the deaths is increasing. So in fact, it also, the COVID-19 also have impact directly to the people health. So when people are afraid or scary of being died, maybe they will think about increasing the demand to buy the insurance. So as you see, the first assumption and the second assumption is a bit contradictory. So that motivated me to do research, and I try to answer the questions like, how does the COVID-19 pandemic change the insurance demand behavior in Vietnam particularly? And does this trend in the insurance demand is similar among genders, age, and different income level? And after that, I will propose some policy recommendation in insurance sector. However, I just want to have a quick note here. So as the data I collect from the Ministry of Finance in Vietnam, the numbers of the life insurance in Vietnam is increasing for the first half of the 2021 in compare with the first half of 2020. However, in fact, as the data is showing here, the number of the life insurance is always increasing through time. What I want to focus here is this the increasing because of the COVID-19 or just because that is more people want to buy the insurance? So what I have done is I collect the online surveys in November in 2021, and during very short time, unfortunately, I just can collect just around 100 respondents. So still I am exploring this topic, and I will wait until the end of this year to have more data to analyze. But until now, I have some following result. At first, this is my quickly data description about the respondent. So in my surveys, I asked some basic questions regarding the gender, the number of dependents, the average income level per month, and the education level, the age, and the household owner. So for example, in my data, 74% of the respondents are female and 26% are male. And the number of dependents are variety, but most of the respondents, they have 0 dependents. So it means maybe they are single or they have husband or wife, but they do not have children yet. And 32% of the respondents, they have 2 dependents, and very few of them have 4 dependents or more than 5 dependents. So mostly they have 0 or 1 or 2 dependents. The next one, I asked about the average income level per month of the respondent. I categorize the average income level into 5 groups, from less than 10 million, from 10 to 20 million, and 20 to 40 million, and etc. So for your information, for example, if I say the average income level per month is 10 million, we can say it is around $500 per month. So in my data, there are most of them, around 40% of the respondents, they have the low income, but still there are the higher and average income. Only 5% of my respondents, they have more than 60 million which is around $3,000 income level per month. And in Vietnam, with this amount of money, we can say that they have the quite high income per month. And also I asked them about the education level regarding the, maybe they are high school student, they are bachelor, they are master, they are doctoral or others. And the next one is about the age of the respondent. I also classify the age from 20 to over 55. And lastly, I asked about the household owner to see if they have the household or not. So 50% of my respondents, they are owning a house, they are having a house. And around 16% of my respondents, they do not have a house and they have to pay for monthly rental payment. And 32% of the respondents, they do not have the house and they do not have to pay for rent. So for this group, maybe they are sharing a house with their parents, right? So they do not have to pay for the rent and they do not have the house as well. This criteria, including gender, number of dependents, average income or education level or age or household owner, is the implication that someone, they have good income or not, and someone, do they have the potential high disposable income. For example, normally if you have more dependents, you will have to pay for more for the dependent. So that is the reason why the disposable income will be less, right? Or if someone have the high average income level per month, so they are expected to have higher disposable income, right? It means they have more savings, etc. So in fact, the criteria for asking this question imply that someone may have higher or lower disposable income. And here are some main statistic results that I have obtained from the respondent regarding to the COVID-19. So in my surveys, I asked the respondent if their income and their saving change after the COVID-19. So here are some the statistic regarding the income after, before and after the COVID-19 and the saving after and before the COVID-19. So here I classify into 6 groups, like they will answer if their income decrease more than 20%, or they decrease less than 20%, or their income is unchanged in compared with before the COVID-19 happened, or maybe their income increased less than 20% or increased more than 20%. So here is the same group for the saving. So as you see, most of the respondents, they have unchanged income and unchanged saving in compare with the before COVID-19. And aside from that, there are more people here. As you can see, the red one and the blue one. The red one and the blue one here showing the decrease. So most of the data show that people is having problem with their income and the saving after the COVID-19, by showing that most of the respondents, they have lower income and lower saving. Just a few of them increase, the purple one here and the purple one here. Just a few of them increase their income. And here we have increased less than 20% or more than 20%. The less than is the green one, and the increase more than 20% is the purple one. So as you can see here, the data show that most of the people, they are having lower income and lower saving. So if we go with the first assumption, if they are having lower income and lower saving, we will feel that, we can assume that it may have the negative impact on the life insurance demand. And this is the main result regarding the life insurance demand before and after COVID-19. So I asked the questions for the respondent is, do you buy life insurance after the COVID-19 pandemic happened? And 75% of my respondents, they say no, they do not buy any new life insurance after the COVID-19. And 25% of them say that they yes, 25% of them say that yes, I do buy the life insurance after the COVID-19. But after that, I asked one more deep questions, like for this group, for this 25% group, that is the COVID-19 is the main reason for you to decide to buy the life insurance. And interestingly, only 15% of 25% say that COVID-19 is the main reason that they decide to buy the life insurance. But 85% of my respondents, they say, no, I buy the life insurance not because of the COVID-19 pandemic. So it means I buy because I want to buy and that is necessary for me, but I do not afraid of the COVID-19. And the COVID-19 is not the reason that motivate me to buy the life insurance. And for me, that is very interesting. Aside from the questions regarding the life insurance demand after the COVID-19 pandemic, I also asked the opinion about the life insurance before and after COVID-19 pandemic happened. So I asked them, what is your opinion about life insurance before? This one is before and this one is after the COVID-19 pandemic happened. So I giving them 4 opinions. The first one is life insurance is a tool to prevent risk. And the second one is life insurance is a tool to save money. And life insurance is a tool for retirement. And the last opinion is I will not buy the life insurance no matter what. So as you can see, this one, the blue one is agree one and the red one is disagree one. And the data show that for the answers of I will not buy the life insurance no matter what, the agree is decreasing after the COVID-19 pandemic. So here we can say that the opinion, the concept about the importance of life insurance is start to change for the people. Because after the COVID-19 pandemic, it's changed from I will not buy this much, like nearly 40%. Here only 25% say that they will not buy the life insurance no matter what. And I also asked some questions regarding the impact of the factors that people will decide to buy the life insurance or not. So basically, I just asked them what kind of factor that will have impact on the decision of buying the life insurance or not. So here, I giving them 5 options. The first one is buying life insurance have protecting my own financial status, and more than 30% of the people agree with that. And the second one is buying life insurance will have reduced the medical expense. And here, 36, the most one, right? The most one that people will choose, will go with this option. They will decide to buy the life insurance because they believe that it will reduce the medical expense. And for the other option regarding like buying life insurance, have saving, have investment, etc., is much lower. So this implies that in the concept of the people, in the mindset of the people, life insurance is not a tool, a good tool for saving and for investment. And here I also ask some questions. What is the reason that you do not buy the life insurance? And some of them, no, many of them, 40% of the people say that they want to buy, but they do not have money. So for example, one life insurance contract, which is very long as well, as a second question, like life insurance require too long time for financial commitment. The commitment for too long time and require people have to pay extra money for preventing something they are not sure about the future. That prevents people to buy the life insurance. And I also see in my in my respondent, they say that they are still young and they are at good health condition, so they do not want to buy the insurance. And finally, 30% of my respondents, they say that they do not trust the life insurance. I don't know how about the other market, but in Vietnam, Facebook is very popular. And sometimes we have some, scandal from the insurance company that, for example, the people do not receive the premium, or they have the difficulties in receiving the premium after having problem with the life insurance. So maybe the problem of trust of life insurance is the very important barrier that prevent people to buy the life insurance in the futures. And yes, I also asked the respondent regarding the company's decision, like what is the criteria that they choose companies for buying the life insurance. And interestingly, that is quite different from my expectation, because my expectation is they will focus on the recommendation by friends, because I believe that the recommendation may have more impact with them. However, 60% of my respondents, they agree that the company with the good reputation and the company with the good policy will be the main criteria for them to select a insurance contract. And I also try to run some regression, but however, my number of observation is still limited, but I still try to run the logic regression to see which factor have the significant impact on the life insurance demand. So I go with the dependent variable, which is the life insurance demand, and the independent variable, including gender, age, income. This is the income from the monthly income and the saving after the COVID-19 to see if they are having increasing or decreasing the saving after the COVID-19 pandemic happened. And the result briefly showing that the gender the gender and the income have significant impact on the life insurance demand. And unfortunately, the saving after COVID-19 pandemic doesn't have the significant impact on the life insurance demand. So that is the result for the regression model that I try to apply. So here are some conclusions. So the data show that COVID-19 doesn't have significant impact on life insurance decision. And in general, 20% of the respondents, they decide to buy their insurance after the COVID-19, and only 28 of them buy insurance because of the COVID-19. In more details, 43% of the respondents, they have the same saving or increased saving during the COVID-19 period, but only 60% of these respondents, they decide to buy the life insurance after the COVID-19 occurs. But only 27 of the increasing saving, they decide to buy life insurance because they're afraid of the COVID-19. And secondly, for the rest of the respondents, the one who have the saving decreasing, only 28% of them decide to buy the life insurance because of the COVID-19. And aside from personal saving behavior, the study also provides some other insight data regarding the factor that impact the life insurance decision of the respondent, including the reputation of the insurance company or the reason why the respondent want to buy the insurance. And also, the 70% of the respondents believe that buying the life insurance will help to reduce medical expense and protect the family from the financial risk. So this result will give us some recommendation for the insurance companies. So they may have some policy that fit to the Vietnam market. So it means they have to care about the reputation. They have to care about the reason that the people in Vietnam particularly want to focus on the life insurance, such as the because of the low income of the respondent, or because they want to focus more on the medical expense, or maybe to increase the market share in Vietnam. Maybe the life insurance company might think about this result. And I think that is for my presentation, as the time is up. And I welcome all the questions and the recommendation from me, as I am the very young and new researcher in this field. Thank you.
Thank you, Dr. Hong, for sharing your research. And is there any questions from the floor?
Okay. Hello.
Hello.
Hello. This is the Mr. Shim from Hanoi, Vietnam. I'm the student of Professor Jung's class covering international business environment. I think this schedule is a little bit behind of the schedule. So if you don't mind, so I will give you a very simple question on the Vietnam insurance market. You mostly mentioned about the insurance policy, life insurance policy, and the trend in Vietnam market. But as far as I understand, you mentioned the life insurance. Is that the non-saving life insurance? Is that right?
No, I say that it is saving life insurance.
Saving types like insurance.
Yes.
So it means that it can be covering risk as well as it can be tool for saving.
Yes, but however, in my questions, when I ask people, they do not care about the saving. They do not care about the saving that much. They just care about the what kind of medical, for example, medical risk or other kind of risk for them, but they do not care that much about the saving because maybe the saving rate is too low.
Okay, I got it. So if you don't mind, I would like another one simple question. Since I'm the foreigners who are doing the business and invested in Vietnam, Hanoi, so that's why during the COVID-19 circumstances, I'm very much afraid of the foreigners who are doing the business in Vietnam. The insurance policy, from the government point of view, insurance policy for foreigners. So do you have any information or any idea about the government insurance policy for the foreigners who are doing the business? Because I think it's since Vietnam is a lot of policy to induce the foreign investment in Vietnam. But as you know that some educational system for the foreigners' kids is quite okay with a lot of international school, but in the still some, as you know, that the medical system and the environment is not such a friendly with the foreigners. So because of that, I think maybe this is a little bit behind of schedule. So if you have any idea or any information or any suggestion for foreigners insurance, or who can provide good insurance program, so let's get in touch. Okay. After this webinar. Anyway, sure. Since today all the participants from the esteemed university and all organization, I think it's very informative and the new findings and the knowledge to me. Thank you to arrange this wonderful opportunity for the student under the Professor Jung's class. So thank you, Ms. Lim, as well as Professor Jung. Thank you.
Dr. Han,
Yes.
as you can see, Mr. Shim is a young and hardworking student of mine.
Okay.
Please take care of him very much after meeting.
He is in Hanoi right now?
Yeah, I think so.
Yes, yes. I'm
Yeah, he's a
Hanoi. I'm
businessman in
living.
Hanoi. Korean
Yes,
businessman in
yes.
Hanoi. Okay.
Yeah, my company is also in Hanoi. In
Okay.
Jiangxing.
Thường Trinh. Okay,
Jiangxing,
okay, I got it.
Changsha.
Okay.
I'm living at the Shibuya. Yeah.
Okay.
Okay.
I got it.
Okay.
I will send you a message and I will get your email, and if you need anything, I can support you for sure.
Oh, thank you, thank you.
Okay.
Dr. Kang Hong,
Okay.
please leave your contact point at the chatting.
Yes,
Okay.
I will send you a message right now.
네, 감사합니다.
You are welcome.
Thank you, Mr. Sim, for the questions. And Dr. Han, I have a short questions about
Yes,
your
go ahead.
paper. Is it okay? And if possible, could you share again your presentation file, because I don't have any regression result.
Yes, because
yeah.
last time I didn't do it.
Yeah.
I tried to run some regression to see if the result is significant, and I just got it. I'm showing you. I apply it in the why it doesn't show? Sorry. But I think I need more data to make it more reliable.
Actually, I also did a survey to Vietnam and other countries about the insurance perception, and I did a multinomial Rosen regression, and I could find only the age. Age is a significant in my research.
Okay.
And in here, what is the reference group of gender? Is it
it is gender, age, income, the normal income, not the income after the COVID-19 and the saving.
I mean, you did a binary.
The logic.
Yeah, I mean, for the gender, what is the reference group? You called it like 1 or 0.
Yes, just 1 or 0.
Yeah, but I couldn't notice that what is the 0 like
0 is I have to open the other file. Sorry. Just a moment. If you want, I can share with you this one later if you want.
Yeah. Because so in your research, gender is a significant variables, and
yes,
it means that I mean, do you have any opinion about the gender effects on the life
so
insurance?
in my coding, the male is 1 and the female is 0. So in this case, the gender, the coefficient, which is minus 1.5. Actually, I just ran the regression yesterday. So
okay.
Sorry for that, because I tried to do some quantitative analysis. But I will have a look, and for sure I will send you an email. We can discuss more about this.
Okay, I will ask you about the result via your email. And also, I have one more question about the trust in insurance company in Vietnam.
Yes.
So you mentioned that the trust in life insurance company in Vietnam is not very good. Is it because of is it because of some scandal, right?
I think scandal is one of the reasons, but the mindset is also one of the reasons as well. So in fact, there is very funny story about the student who learn insurance in Vietnam, and sometimes they are not very proud of learning about the insurance, because still insurance is a new field, and because maybe I think, for example, the life insurance, for example, they have to pay for a very long time, so they need long time to confirm everything. Like maybe when I died, I will receive the premium, etc. So the problem of trust about the life insurance, I think, is very big problem. I don't know how about for Korea, but for example, in Vietnam, they have a lot of problem. And because another problem, I think, is coming from the social media. and from the banker insurance as well. So for example, when I go to the bank, every time the people they ask me if I want to buy the insurance, I say, no, I already have one. And they say, do you want to buy for your husband, for your kid, for your grandparent, etc. And sometimes people feel that the insurance company is chasing them, like try to ask them to force them to buy the insurance. So I think that will have impact on the mindset, on the behavior. Like if there is something good, why do you have to chase me that much? That is just the idea. For me, I trust the life insurance, I buy it, but I think in general, many people feel annoying about that.
Okay, I see. Thank you. Thank you for sharing your opinion.
Okay, you're welcome. Regarding the regression, I will let you know later.
Okay, I will contact you.
Okay.
And I think there is no more questions. And next presenter is Miss Solita from National University of Laos. She is a lecturer at National University of Laos, and she was a visiting researcher at the University of Lausanne in 2019, where we met each other in Switzerland. And she will present about the factors affecting consumer purchasing decision of motor insurance in Vietnam, in Vientiane capital. And Solita, if you can share your screen, please share your screen and make a presentation.
Okay, good morning, everyone. Can you see my screen right now?
Yes.
Okay. Okay, good morning, everyone, and Professor Chung. Thank you for giving me the opportunity to share the information about my small research studies about factors affecting consumer purchasing decisions of motor insurance. The case study I will focus in Vientiane capital in Laos PDR. Okay. For the reason why I chose to study the motor insurance in Vientiane capital, so as you may know, Laos PDR is a developing country, and the number of vehicles in Laos PDR is increasing every year. So according to the Laosis is a Laos statistic information system that provide the information about the statistic related to many fields, for example, agriculture or communications and etc. Information that related to Laos. So according to this source, I found that the number of accidents in the Laos PDR, especially in capital, in Vientiane capital, rise year by year, as you can see in the slides, and the number of insurance companies in Laos also increased, because now there are 22 insurance company that registers from the Ministry of Finance under the Department of State-Owned Enterprise and Insurance Management. And the one thing that I noticed is that many people, or I would say many car owner or vehicle owner in Laos or in Vientiane, some of them, they don't have or don't buy the car insurance policy, because some of them, they might not know the benefit that they will get from the insurance company. And they might not know or might not concerned about the effect when the accident happens. It might affect their financial position in the future. So this is the reason why I want to study for the people who own the car insurance policy, and what is the factor that affect them to buy the insurance. So the main aim, remove this a bit. We can remove it. Okay, the aim of this study is to investigate factors that affecting customer purchasing decision on car insurance. And under this aim, there are 3 objectives, which is to understand the relationship between service quality factor and consumer purchasing decision. And the second one is to understand the relationship between brand factor and consumer purchasing decision. And the third one is understand the relationship between marketing mix of 4 P factors that affect the customer purchasing decision on car insurance in Lao PDR. For the expected outcomes in this study, so I want to know and understand which factor will affect customer purchasing decision on car or motor insurance. And the second one is to be a guideline for insurance companies to develop their strategy plan in order to compete with their competitors. And also if they can understand the factor that affects the customer to buy the insurance policy. So it will helpful for the insurance companies to develop the most suitable products to meet customer needs and satisfaction. So here is a conceptual framework from my study. So in here, I have 3 independent variables, which are service quality factors, brand factors, and marketing mix factors, which I assume that these 3 factors will affect the dependent variables, which is customer purchase decision on motor insurance. So I want to examine whether the 3 of these factors will affect the customer's purchase decision on motor insurance. Which one is the best factor that affect them? So for the material and methods, there we will talk about the sample size, the methodology that I use, and the way of I collect the data, and the method that I use to analyze, which is SPSS program, and the hypothesis testing, which I have the 3 hypotheses in this study. So I will go in detail in the next slides. As I say, the sample of this study is the people who live in Vientiane capital, because Vientiane capital is the biggest province in Laos PDR, and there are the many people living here. So I think it is will be a good sample size to represent all the population in Laos PDR. So the study will focus on the people who have motor insurance policy in their hand. So we can ask whether that which factor that affect them to buy the motor insurance. Here is the example of the information that I got from Laos's website that showed that the number of accidents that happen in Laos, that it is divided by provinces, and the Vientiane capital has the highest number of the accidents. And this one is in 2020. So for the methodology in this study, I use the Cronbach alpha to examine whether the information or the data that I collect from the participant from the questionnaire is reliable or not, or we can use it to analyze and get the precise results or not. So in this study, I use the online questionnaire because during the time of collecting the data, it is have the COVID-19 pandemic, so we cannot generate the questionnaire in person. So the way that I generate the questionnaire is via Facebook and Google Form that I send to mainly to my student, and they can help me to pass the questionnaire to their friends and my co-workers and my friends that work in other companies in Vientiane, that they can help me to fill up the questionnaire. So from this table, we will talk about the reliable results for the variable. In here, we can see that the coverage alpha for the three independent variables for service quality, brand factors, and marketing mix factors have the value more than 0.7. So it is, we would say that the reliability of data in this variable is acceptable, and we can use the data to analyze. So talking about the questionnaire, in the questionnaire consists of 48 questions, and it's divided by two sections. So the question 1 to question 11. Oh, sorry, what happened? Okay. Question 1 to question 11, I asked them about the general information about age, about their education background, or are they income per month, etc. And the questions 12 to 48 is a question that asks about the variety of variable in services, service quality, brand, and marketing mix, which affect customer purchasing decision on car insurance. Here in this study, I have 3 hypotheses, which the first one is service quality factors have positively significant influence on consumer purchasing decision on car insurance. And the second hypothesis will talk about brand factors that has positively significant influence on purchasing decision on car insurance. And the third one is marketing mix of 4 P's factors that have positively significant influence on consumer purchasing decision of car insurance. So for the study, I used the 5-point of Likert scale range, which the range is when the range of sales will divided by 0.8, and it represents what the range is from 1 to 5, and each rank represents strongly disagree to strongly agree respectively. The results of demographics data of respondents, I can conclude that most of the respondents are female, which is cover 55% of the respondent, and most of them are the age around 20 to 30 years old. More than half of them are married, and following by the single people for the respondent. Because most of them are in the age 20 to 30 years old, so 85% of the respondents are holding bachelor degree. So in here, for bachelor degree, it might overlap for the people who graduated from university already, and the respondent that answered the questionnaire, they are still studying in the university. For example, the student that fill up the questionnaire, so they might understand that they are studying in the university in the bachelor degree. So they answer the questionnaires for the education background in this level. And the occupation status, most of them are employee, and they have income per month between 1 million to 3 million gifts per month. And during the data collections, the respondent, they are holding car insurance policies. Most of them which are 31.25% are holding policy from Laos insurance company, followed by insurance Allianz Insurance Company and Tipanya Insurance Company, respectively. And for the car insurance policy that they are holding, more than 60% of the respondents are holding the volunteer type of insurance policy, which means the policy they are holding cover the policy holder and the third party when the accident is happened. And only 16% are holding compulsory or basic type of car insurance. So the basic type of car insurance is the policy, what can I say, the car insurance policy that's requested by law that every car owner have to hold this type of car insurance if they are having a car. So the usage of car per week, more than 50% of the respondents, they are using the car every day, and the 89% of the respondents, they said that they will renew the contract from the current policy or the current company that they bought the insurance previously. And only 11% of the respondents said that they will renew the contract, or they will buy the contract from the new company if the policy expires. And the last one, we will be looking about the factors that influence the buy the car insurance here. I can say that 29.75% of the respondents bought the car insurance policy by the advice from their friends and cousins. And the second one is will buy, or they bought the car insurance by the advertise, or they saw the advertisement from the maybe from Facebook or from the television, so they decided to buy the insurance by this media. So now we will talk about the result for which factors that will affect the respondent to buy the insurance. Oh, sorry. For the service quality factor, as we can see in the service quality factor, the first one, the sales agent provides all the details about the contract's condition clearly, is the main variable that affects the customer or the respondent to buy the car insurance from the company that they bought the insurance policy. For the brand factors, the variable that affect them to buy it under brand factor is they can, from their current car insurance policy has a good reputation. So talking about brand reputation is the main factor that they will think about when they will decide to buy the car insurance from the company. About the marketing mix factors, the factors that impact them the most to buy the insurance policy is the term of coverage condition are easy to understand. So it means that they have the advertisement that tell them about the detail that it cover, and the factors or the variables that impact them. The lowest factor that impact them is discount on other products such as life insurance. That is not to surprise me, because when you use or when you buy the insurance, the car insurance, you don't have the the promotion to buy the life insurance or other insurance in discount rates. So talking about hypothesis testing, as I said, there are 3 hypotheses in this study, which is test about service factor, brand factor, and 4P factors or marketing mix factor that affects customer to buy the car insurance policy from the companies, so from the insurance companies. In this study, I use the multiple linear regressions to examine which factor that will affect the customer to buy the insurance. So from this table, as we can see the table when we look at the B value that shows which factor affects the dependent variable most. And we can see 4P has the highest B value here. It has 0.493, which means that P value has a significant effect to customer to buy a motor insurance. And following by service factors and brand factors. Hence, we can conclude that when people or the dependent or the respondents in this study, they consider to buy or purchase the car insurance, the marketing mix factor is the most influential factor that affect them to buy the car insurance. And from the table, from the multiple linear regression table, so I can summarize the table into the regression model. So I can write the model here. Y equal we can see beta 0 1.011 plus 0.167 x1. So x1 represents service quality factors plus 0.109 x2, which is represent brand factors, and the last ones plus 0.495 x3, which is represent marketing factors. So I can summarize in model like this. So as shown in the table here, we can see R has a 0.741, which means that customer processing decision and independent variable, which are service, brand, and marketing mix are correlated. So R square, which means here R square, which is the proportion of the variance independent variable accounted by model. So the value is 0.549, and we have adjusted R square is 0.546 with 3 independent variables. So in this number indicates that independent variable can explain 54.6% if we times this by 100 of the variance in the dependent variable. So it can represent 54%. So now we will come up with the conclusion and recommendations. First one, I will talk about the limitations due to the widespread of epidemic of COVID-19. The researcher have to collect data via using social media instead of generating questionnaire to the respondent directly. So, however, besides distributing the online questionnaire, I also use the printed questionnaire to distribute in the area near my house and in my office. This is to make sure that the data collected is reliable and it generated the most variable outcomes. For the recommendations to the related parties, for example, the insurance companies for the demographic results. The insurance company have to introduce the most appropriate character of the target customer and the ability to plan strategy for target audience more clearly, successfully, and commercially. For the service factor, the company have to improve knowledge and skill for front service by provide them training, maybe short training for them, and employees should be more emphatic about the services, so more welcome to service their customers. For brand factors, the reputation of the organizations and the recognition of the car insurance markets is very important part of the purchase decision, as the result of the study is shown that the company reputations is the most impact factor that influence the customer to buy the car insurance. And the constant development and improved strategy to compete with the competitors also is a main factor that the company have to focus on. And the last one, for the marketing mix factors, the company have to emphasize to develop their 4 Ps regularly, and it is very useful for the entrepreneurs to bring the result of this study to develop the business structures, so they can develop their 4P strategy and to influence their target customer more. For the recommendation to the education sector, if they want to use or to expand the result from this study, it is recommended to study another demographic or sample group. As for example, this study focus only the people or the respondent who live in Vientiane capital. So the next study might include other provinces. And the second one, the study with the variable that may related to the variable study in this study. So we have to, they might add more variable factors that might affect this consumer to process the motor insurance policy. And the last ones, they might study which media is most effective in motivating customer processing decisions. So it is related to the marketing mix and which media that might affect the customer processing decisions. As Linda Lam mentions about the now we use the application to for the customer to use that to buy the insurance policy. So the insurance company might study this field to examine more about which media or which factor that might influence or might help them to get into their target customer. Okay, thank you for your attention and listening. That is all for my presentations about the factors that affect customer purchasing decisions. If you have any comments or questions, please feel free to ask me.
Thank you, Ms.
Thank
Lolita, for your research. And is there any question from floor?